So what we have here is a trust which has earned some trust distribution income. You'll notice there's nothing in here associated with the business. Everything here is investment related, including those bank charges of $5, and on the balance sheet, nothing that would indicate that it's a business. That's important when you get through to the tax return, because if there's anything associated with a business, it's going to create business related reporting requirements. And in this case, this is just an investment vehicle. We want to avoid those requirements. So we've got our share of trust distribution classified correctly, and the bank charges classified as bank charges and tagged as investment related deductions. That's important. Head over to the form. Actually, let me take this form out and I'll start again. I'll put a fresh form in. So again, what we want is we want to make sure the trust section is activated and the reconciliation section. Now what you'll notice is that it's reflecting a $5 loss, which is the loss associated with the investment income deductions, the bank charges. It's not picking up the income. The reason for that is that we need to go to the trust section, and you'll see here actually it doesn't show the accounting value, but we need to add in a worksheet. So you can put in the details for the trust that's paying this income, and we've got the income of the trust estate, which in this case, let's just say that it is $100. It's very possible that all the numbers here are quite different. Okay, so let's go through this and see. So trust estate income, it's probably not primary, it's non-primary, and we've probably got something like non-primary income. And of course you'd have to look at the trust that this is receiving the income from. They should give you a distribution statement which should map directly in here. Okay, so let's just say for the example here that is a franked distribution and it did have franking credits. Now you can see what's happening is that the income, let's have a look in the reconciliation section. So we've got the $95 accounting profit. We've got the $70 from the trust, right? Don't forget with the trust that we're splitting out the 70, and obviously it also split out the credits. You'll see that in a moment. But essentially what's happening is it's including the tax values and it's excluding the accounting values. And it's including the tax values, as in including the deduction, which in this case is one and the same. So that's why the 5 and the 5. The 5 is coming in and going out. It's removing the accounting bank charges and it's including the tax bank charges, and doing the same up here for the income. It's essentially how it's working. Now of course when we come to split out that income, you can see we'd be splitting out the franking credits, we'd be splitting out the frank distribution, and we'd be splitting out the non-primary, the $5, essentially the non-primary loss, which in this case you can, even though there is a bit of a loss here, you can still split this because overall there's a distributable surplus.